We just have some earnings per share from JPMorgan coming in at 78 cents versus the $2.65 year on year. First quarter provision for credit losses coming in at $8.2 billion versus $1.5 billion year on year. Again, I don't know whether the year on year is of any use to anyone, Tom, given we're looking at unprecedented things. Tom Michaud was also talking about change in accountancy, but certainly we need to see what they do with the dividend
I'll tell you,
provisions.
Just to hear that, so that number is a lower earnings number because of a bigger provision. So I think we were in the $3.9 billion range for provision. So but we had the provision doubling from our original estimate from the first quarter to the second quarter. So now if they pulled some of the second quarter provision into the first quarter, that would be worth hearing. So that is a bigger provision number. And I think the market's going to want to know why that number ended up being bigger and what was the decision-making that went into that.
And it's a much bigger number from a $1.5 billion year over year blowing out to $8 billion. Again, let's not forget the scale of JPMorgan, folks, and we're seeing this across the headlines. I'm using the Bloomberg terminal on my cell phone, which I'll be honest is extraordinary, with $28 billion of first quarter revenue. Tom Michaud, there's one number here which really speaks of the moment, and this is the first I've ever seen. They'll report a first quarter return on the tangible common equity of 5%. Tom Michaud, what is your belief that JPMorgan and the banks of Keefe, Bruyette, and Woods can crash down to a low 5% return on common equity and build that back to where they were just 90 days ago? How long is that going to take?
So here's what the new accounting rules require. They require banks to take what they expect the provision to be over the life of the loans right away. So it used to be that we would provide for loan losses about equal to what the charge-offs were and as the losses were occurring. So it was a little bit more real time. Now they're being forced to front load it and then move beyond it. So what you'll see in our estimates is you'll see that we think that this year is going to be the provisioning year, and probably next year is going to be the net charge-off year, because there's a lot of deferral programs here. So that's going to delay the losses. So you'll see probably a lot of provisioning this quarter and next quarter, and you'll see less loan losses, and they won't show up until the end of the year and next year. And the market's going to have to decide how it feels about this, because that is a bigger number, at least, than we were expecting. But, we'll hear how Jamie and the team describe it. But, again, this is what I was talking about. We're in a new loan loss regime.